Hey everybody, welcome to another edition of the Free Toaster News Pod. I'm your host Carlos Caro. I'm here with Toaster co-founder Nick Madrid. Today we're going to be talking about NerdWallet's Q1 26 earnings. Before we get to that, I want to pause and thank our sponsors, Spinwheel, Fintel Connect, and Bulldog Media Group. And Nick, man, this I've been watching their stock. It's down like 32% since earnings. Um, I wasn't expecting that reaction. It was only down like 15% when they first talked about it, but market has not been pleased here. If you're on our newsletter, you probably saw this morning we put out a breakdown of what some of the things that stood out to us. But if you're not yet on our newsletter, go check it out. It's at thefreetoaster.com. We publish an edition every Wednesday. We cover news at the intersection of marketing, consumer lending, and technology. And I think this story fits the bill here, Nick. We have consumer lending, marketplaces, technology, AI. It's all kind of here. Before we get into my observations from the earnings call, I want to just kind of ground everyone on what NerdWallet shared. So 222 million in top line revenue. That's 6% year over year growth. So pretty reasonable headline numbers. They like to talk in non-GAAP operating income, and that's 34 million. So they did turn a profit. And then the margin on that was 15% on the non-GAAP operating income. Notably, their cash position dropped. Maybe we can talk about that a little bit. But they went from like the 90s to 56 million. So it looks like they spent a good deal of their cash in the quarter. And yeah, I mean, let's just get right to the observations. So they acknowledge a major insurance carrier dropped off. I've had people ping me and they were like, was it Geico? Was it Progressive? Everyone has their opinion. Progressive seems to be the consensus, Nick. If you just kind of pull what people hit me with on LinkedIn and like over email, so that's what I'm hearing. I have no way to know if that's true, but I do have friends in the industry that have told me that those three big players, Geico, Allstate, and Progressive, tend to run very hot and cold when it comes with to affiliate platforms. So they'll lean in really hard when they need the volume. They'll pull back really hard when they're satisfied and they want to slow down. So it seems to me like affiliate marketplaces like NerdWallet have been kind of like the incremental lever that they can pull when they need the volume. So I wouldn't be surprised if it was something like that hit NerdWallet this quarter, but they did continue to guide that the softness would continue into Q2, and I think that spooked the market a little bit. And Tim Chen, their CEO, he did acknowledge, there's a quote, "We have a lot of concentration towards a few carriers currently and a few channels." I read a few channels as we're not really putting insurance products in all that many places. So when those few carriers hit us with pullbacks, it kind of tends to disproportionately disrupt things. So that was observation one. So why that matters is their narrative leading up to this quarter had been, hey, cards down, and yeah, there's some SEO softness, but insurance is saving the day. We're rocket shipping here. It's all going to be good. And now it's clear that rocket ship may have some expiry, unless these big carriers, we see them come back and lean in the next couple of quarters. So we'll keep our eye on it. The next one was their small business segment. So they were down 15% year over year, down to 25 million from a year ago. And what I found it kind of interesting, like no one even asked any questions about it. It was like, it kind of struck me as like, wow, that seems important. Maybe we should talk about this. Nope. No analyst questions. No commentary from the exec team on how they're going to turn around. Just a flat, we're down 15% year over year. All right, so we're going to talk about the next one. My favorite thing to talk about, or one of my favorite things to talk about lately, is the organic search. So they talked about, in quotes, organic search headwinds. So that they repeated that a few times. And initially they had, and Nick, you and I talked about this in our last pod about NerdWallet. They specifically said we're no longer going to report at the business unit level. Like we're not going to tell you what's going on in insurance and cards and SMB. And they were true to their word in the investor letter. We read it through. We didn't see cards broken out. In fact, when we published the edition this morning, we didn't cover that. But you just found in our preparation for this pod a breakdown on their website that actually gets into that. So I don't want to spoil it, but we'll get to that in a second. But what I noticed was the card business was down 33% year over year from Q1 25 to Q1 26. I suspected it was going to be down, Nick, but 33% is a lot. That's a big, big chunky number. And it's connected to this, right? It's they were a massive, massive player in SEO, talking about rewards points and transfer hacks and all sorts of cool content that they continue to still publish in the category. The challenge is that they're not getting the eyeballs on that content like they used to, because people are now jamming with Claude and with GPT. They're getting their answers there, and they're not getting enough people clicking through to their pages so that they can click on those paid affiliate links that drive the revenue. So they're still struggling with that. And now we can put a number to it. So 33% down, and maybe we'll analyze that a little bit. The other thing I noticed that they did focus in the headline print the $34 million on non-GAAP operating income, but it had a big asterisk because they didn't run their Super Bowl ad this year in Q1 like they did last year, and that I think that made a big difference in the comp. In fact, they guided non-GAAP operating income down from the 34 million we saw here in Q2 down to the 6 to 14 million range. So a pretty big haircut quarter to quarter. So that seems like maybe that'll be the more sustainable number we'll see Q to Q. But we'll find out. And then the last thing I kind of observed from the earnings call was they talked about this referral business they have now in the insurance. So they're a registered insurance broker. They're driving leads to their own agency, and that's still part of their strategy. What my observation here is, like, in my view, their superpower is their lead gen marketplace, their ability to work with lenders, their ability to drive consumer interest and demand to different lending products. And this whole insurance agency, it's just a different ballgame. Like, I think it's not an easy business. I assume it's very competitive. I assume it's lower margin than lead gen. So it's still hard for me to read what is this offense, is this defense. I don't know. It feels like my read of the situation. We were just looking at their top line revenues. They've found a way, to their credit, to drive top line growth year to year for many years now. So if you had no context at all and you were just a robot looking at their top line, you'd say, hey, this business is crushing. It went from like the 200s in 2020. Now they're in like the 800s on top line revenue. This thing's rocket shipping and it's growing, but the composition of the business, the margin profile and all of it, their former cash cow business, like the cards segment, is still under tons of pressure. So I'm personally worried about the continued health of the business, just reading between the lines on the numbers and the commentary. But Nick, I'm curious, like, I know you've been digging. What else have you seen?
Yeah, Carlos, thank you. Thanks for that. You're not the only one, right? And so there's two things that stood out for me in this initial research. One, and we'll put it up on the screen, is back in March 13th of this year, Morgan Stanley, who's a research group and team that we actually really respect for covering both the stock and the company itself, they downgraded NerdWallet because they're questioning the durable business that NerdWallet is in. Profitable growth looks challenging in the age of AI. They're downgrading to underweight. At the time, NerdWallet was trading around $10, $10.36 to be exact. They had an underwrite price target of $9, and I actually think as we speak, it's trading about $7.50. So it's like even below the underwrite there. Obviously, that's post earnings that we're talking about today. So you're not the only one that has those concerns. There's a few things that I found interesting. One, let's cover just while we're at it, and then we'll get into the segments. Is this share of inbound referral traffic? from ChatGPT, right? Because I think it's clear that there's SEO headwinds, but like what's potentially going to replace that? And so in the earnings call, Tim Chen basically was answering an analyst from William Blair, and Tim quotes, in terms of LLM traffic, pretty much of the same story as last quarter. We're pretty dominant, which is what we're trying to explore here, is when it comes to LLM share in financial services or money questions, based on all the third-party data we've seen. So we do see people coming through. We see high conversion rates. It's just a very small piece of our overall pie right now from a revenue perspective, and that's end quote. And so Morgan Stanley does a great job at kind of giving us some context into what that pretty dominant means. And so let me bring it up for us, and then we can unpack it. So again, this is Morgan Stanley, the report from March. They source SimilarWeb and then their own research. And like, this is a pretty clear divergence. This is share of inbound referral, right? So we don't know the magnitude of this, but we at least presumably know the share between NerdWallet, Bankrate, LendingTree, and Credit Karma. And at least per this graph, per this analysis, and what Tim is saying, it actually is true that they are knocking this out of the park. We just don't know the size and scale.
Yeah, it's the first quantification I've seen of this specific question. I think it's interesting. They did choose some of the leaders in the space, Karma, LendingTree, Bankrate. I do think those are fair comps given what we're talking about here. A lot of questions come to mind for me. Like, one, we don't know exactly what we're talking about here. Is it cards? Is it insurance? Like, what exactly? Like, is there a lens, like a category lens we're putting on this, or is this just any referral out to these domains? I'm just going to assume it's any referral across anything. So it might be apples and oranges a little bit, because NerdWallet, Bankrate, LendingTree, Karma, they all have different like product mixes and composition, etc. And I know, for example, at Karma, content's not a big driver for their traffic. So to see that their content isn't cited as often in GPT isn't a surprise. But yeah, the question, Nick, is like, well, how big is this? How many referrals is this? How many dollars are we talking about here? Like that to me is the bigger question. And is it enough over time to offset the softness that's coming from
That's the thing. I mean,
from SEO?
clearly NerdWallet, is one of their strengths is in content. And it's very clear that these models that were trained, some of them many years ago, like that content was there for them to pick up. So then the question is, the content's always going to be there. And how long is that durable versus a new piece of content coming in? This now opens up different questions of like, if you do play the content game, is your content structured in a way for an LLM to actually scrape it and database it and index it in a way that makes sense for them? So like, and I don't have a take on that. Maybe that's something to form later on. Is like, of the NerdWallet content that's out there that's clearly outperforming here, is it structured in a way that LLMs like it over time? So we'll have to,
Yeah. And then the other question is, and are these referrals converting? I've heard from operators at other affiliate platforms that have just been willing to share with me candidly that the referrals coming from GPT are just like, it's like another breed of lead. Like when someone clicks out from a chat conversation, whether it be Claude or GPT or any of the LLMs, the conversion intent is just crazy, because they've had the full conversation, their objections have been handled, like everything's kind of ready to go, and now they're in like straight transaction mode. So while there's much fewer of those leads, like the conversion rates are like, I've heard anywhere from 5 to 10x like a normal Google lead, which is obviously an important consideration in all of this. Nick, one more thing I'll say here. It's like it strikes, because you mentioned the NerdWallet brand, and I actually think it's one of their bigger assets, is like just the power of the brand in like comparison shopping, financial advice, that sort of thing. And given they're not getting as much, let's just call it free traffic from Google that they used to, I'm surprised they've made the decision to lean away from brand marketing. To me, as a CMO, that might be a moment to lean in, because that's one of your biggest assets. And if you're gonna find a way to turn the business around, and you're not going to rely on Google, I think you have to find ways for people to discover you in different ways, right? You want them to land on your site organically. I know they invest in podcasts and newsletters. They have a lot of different. They have diversity of their content strategy. But if Google's not going to play ball with you and play nice, like you got to go around them. And I'm not saying Super Bowl ads are necessarily the best way to do that, but I would want to see as a brand marketer their brand spend increasing over time, not decreasing. And I feel like they're playing a little bit of like short-term optics here so that they can report the positive print on the NGOI and things like that versus thinking long term. And that part of that is what colors my like concern here about what I'm seeing. So
Let me take it a different direction. And I can't explain this. I couldn't find out why this is the case. We were told before that they're no longer reporting on segments, but presumably we found segments. And so this is directly from investors.nerdwallet.com, quarterly results. You go to 2026, you see Q1, and you have historical financials. And it's an Excel document that opens up. And so we actually got clarity into what happened with the card business, which you mentioned before. And so we get a breakout of insurance, credit cards, SMB, loans, and emerging vehicles. And just to kind of give you the recap, insurance was down year over year by 5%. Credit cards was down 30%. SMB was down 10%. But loans and emerging verticals, so loans was up 50%. Emerging was up 50% as well. That's year over year. And so I don't know why this is here. I genuinely don't know why we're able to see this data because I thought that they weren't going to report on this. But What do you think of a 30% decline year over year? Let's start
I mean it's scary. It's scary. I mean that feels. I mean I mean put it differently. I knew it was going to be down, or at least I suspected it was going to be down. But I would have guessed in the range of like 10 to 20%. 33%, man, that's pretty off the rails. I wonder if they're even trying seriously to make some of that back in performance marketing. And I know before the show, Nick, we were like riffing a little bit on that, but the market in cards specifically is extremely competitive. Like you have the Amexes, the Capital Ones, the Chases, like huge budgets. Incredibly good analytics teams that can arbitrage the hell out of anything, whether it be Meta, Google, any paid marketing channel. They know exactly their LTV. They know exactly what they're willing to pay. They're great at optimizing for conversion rate. And furthermore, they have the whole lifetime value of the customer. When they succeed, not only do they get the card customer, but they could get the bank account. They could get a number of things long term with that customer relationship. And NerdWallet just gets the bounty, which is just a fraction of the lifetime value. NerdWallet's advantage is when they earn the click that they can sell a customer on a wide variety of different products. So the game here in search for them is going to be higher conversion than the card issuers, but lower payouts or lower like LTVs on each of those conversions. So it'll be interesting to see how it plays out. But I guess to your question, this tells me they're not leaning in aggressively on paid for cards, because when I look at other issuers and I see their results across other affiliate channels and cards, the numbers have been moving up. Forget down 30%. Like how did it in a normal season for NerdWallet, that should have been 10 to 20% up on the card business. So like that's the frame I look at it, is like, okay, they could have been up 20%, but they were down 30. That's a pretty big gap. So that just tells me that SEO story is continuing to hit them, and they've either strategically decided that paid marketing is not going to be the solution, or they've tried and they just haven't gotten it to work yet. So I don't know which narrative is right.
Maybe this is a good segue to our event, because I think there'll be plenty of time to talk about performance marketing. But why don't you take us home?
Yeah, no. So I guess to wrap for today, we're going to do. If you've been following our newsletter or our LinkedIn, you probably know this already, but we're going to do an affiliate marketing summit just for lenders in San Francisco, September 23rd and 24th. And the audience we're looking to curate is senior. So if you're a VP plus at a publisher or at a lender, we'd love to have you there. So we'll close with that, and excited to do this again next Friday, Nick.
Thanks,
I'll talk to you then. All right, bye.